Our next guest says 2023 has been another lackluster year following that horrendous 2022, but bond issuance in the muni market has started to pick up over the past couple of weeks with that rally in rates, and the big question is, how much further can it go? Jonathan Mondillo joining us right now, head of North American Fixed Income over at Abrdn. And John, let's start there here. I mean, we've seen a little bit of a perk up in the market here, and I know there's been a lot of sort of waiting for some sort of stability in the Fed rate environment, the Treasury rate environment, that maybe gives a green light to the muni environment.
Yeah, I mean, a lot of investors in the tax-exempt municipal bond space are probably still licking their wounds. As you said, 2022 was nothing short of a bloodbath for municipal investors who are not used to seeing red. This year, lackluster up until about 2 weeks ago. But I think for us, we've been looking for sort of that catalyst that gets investors off the sideline, right? Where has the money gone to over the last year to 2 years? It's been to T-bills, it's been to money market funds. And I think as we get to peak cycle, which we feel like we're at right now, investors need to start thinking about where they're going to be invested long term. We think tax-exempt munis are extremely attractive at the moment.
Well, that's exactly what I wanted to talk about. How do you compete with cash right now? Is it just warning about reinvestment risk and talking about the long term?
It's tough. It's been a difficult conversation, but I think if you look at taxable equivalent yields, whether it be at the front end relative to municipal money market funds versus Treasury money market funds, or if we extend out longer, there's still a pickup on a taxable equivalent basis within tax-exempt municipal bonds. I think secondarily to that too, missing out on what could be pretty hefty total returns on a go-forward basis is what investors need to be focused on. So there's that excess yield component, which I think is attractive in tax-exempt munis, but also from a total return perspective, in a pause environment, munis out-return T-bills. Munis have out-returned, at least over the past 3 pause cycles, the S&P 500, as well as corporate bonds. So investors, I think, really need to wake up here and start to invest in the asset class.
Well, what's the downside here? What is the biggest risk to the muni market as it stands right now, would you say?
I think the biggest risk to the muni market is, as it always is, which I view as very minimal, which is the loss of tax exemption. But headed into 2024, it's always talked about when we go into an election cycle. I just think that when we weigh that outsized risk versus the potential returns, municipals as an asset class, it's tough to find a better or more attractive asset class, right? So if we're entering a recessionary environment, fundamentals look extremely strong relative to other asset classes. Yield component, we're now at certainly 10-plus year highs in terms of yields. And then I think what gets lost too is when you compare ratios of munis versus corporates, when you compare ratios of munis versus treasuries, they look pretty much in line, right? But I think what gets lost as well is the fact that when yields tick up, the tax exemption that gets passed off to investors goes up as well. Yeah. So at a 1% yield, it's worth 58 basis points. At a 5% yield, it's worth 300 basis points of excess income, and that's real.